All right, thanks for joining again. We're going to talk this time, and this will be a slightly longer video than we've had in some of the others, but we want to talk about something called option spreads. And the reason it'll be a little bit longer is we're just going to show you a bunch of examples, and there are many different kinds, and so we want to try to cover at least the common ones. So an option spread is really, it's not a difficult concept. It's just that it has multiple strike prices, or multiple, often called legs. So when you put on an option spread, what it means is you're entering a trade, and it could be either buying or selling across multiple different strike prices. And some simple spreads have two legs or two strike prices, and I'm going to show you examples of these again. Some have three, some have four, some have even more than that. So when you're entering a position, whatever your strategy is, and it might be, again, it could be, most common spread is just a simple, what we call a vertical spread or a two-legged spread. And so as we look at a call credit spread or a put credit spread, those just have two legs. And when you enter them, you're entering them on two different strike prices. So again, we'll show you examples of this. They can be entered for either a debit or a credit. When we look at some of these examples, you'll see that. But in other words, you can enter one where you're buying something and then selling something that's more expensive. And so that's going to be a credit because you're selling as a credit. And so if the selling one is more expensive, you're kind of a net seller. That would be a credit. Or you could buy something and then you could sell something less expensive. It would be a two-legged spread in the other direction, and that one would be a debit. So those aren't necessarily, just because you get a credit, that doesn't automatically make it better. Because eventually you're going to have to close these out. So if you bought something for $1, but you were able to sell it later for $3, that's good. If you sold something for $3 and later you were able to close it out or buy it back for $1, that's equally good. So it's just a matter of which order you're doing them in. One isn't necessarily better than the other. You'll also hear terminology about the spreads. Often they're called vertical spreads or horizontal spreads. Vertical spreads, and the terminology just comes from the way option chains are often laid out. Often you have in a vertical line, an up and down line is where all your strike prices are. So if you use the same expiration, but you're using different strikes, they're along a vertical line. Sometimes option chains, historically especially, were laid out with charts that had the different expiration dates going right to left. So if I chose a strike price from one, and then I chose a different expiration date for the other strike price, well, that would be horizontal. And there is, in fact, some people trade something called a diagonal, which actually is not the same strike price on a different expiration, but a different expiration and a different strike price. So those are diagonals. We won't look at any of those, but it is another strategy that some people use. So bottom line is, what can be constructed with option spreads is almost endless. So I'm going to show you the most common examples, and then the idea is to give you the background, so when we get into talking about strategies and how you lay a trade out that we have a strategy for, that ultimately we can make money with, these things will make sense. All right, let's look at the first one. Okay, let's look at what we have here. So let's go down to the bottom and first kind of look at what we've constructed. So you can see that the underlying is Apple, and we sold one contract, and that was at the 150 strike price, right? So this is a call credit spread. So these are call options, and we constructed something that is where we sold something for $4, and here's the amount, and we bought something. We bought basically the same expiration. This is the 17 December expiration. At the time I'm recording this is about a month out or so. Doesn't really matter. But you can see that the one that we bought was less expensive. So this is going to be a net credit of $3, right? We sold something for $4, bought something for $1. So that's a $3 credit. times 100, which means we got a $300 credit when we open the trade. Now, what you can see is that if you look at the line up here, that the expiration line maxes out at exactly that same $300. So the credit we collect, if it expires anywhere below this 150 mark, we just keep that credit. It goes, the value goes to zero. Nobody can buy it back. It's closed. It expires, and we get to keep the $300. So this, you can see, is a bearish position. You can sort of see that it's leaning towards the left, meaning that if we go a price of 150, which is about where it's at now, it's at 149.73. If we go 150 or below, we're going to make money. If we start to go above 150, we start to eat into that $4 credit, and we have protection at some point from this one, but there's $10 in between there. You can see between 150 and 160 before that protection really kicks in. And so we have a max risk on this if we were to go to the moon of $700. So that's the most we can lose, is $700, because what will happen is this 160 will eventually start to pay off if it gets in the money, and it will start to pay off at the same rate that the 150 is losing money. So I know it can be a little twisty to think about it, but if you just think of a call credit spread or any credit spread as I'm selling something more expensive than what I'm buying, call credit spreads are always bearish, by the way. Put credit spreads, which we'll show you an example of, are always bullish. Call debit spreads are always bullish, and put debit spreads are always bearish. So not something you need to really remember necessarily. You'll always see it on the graph, but there are several ways you can know that it's bearish, and it's quite simply, if you just look at when the price is lower, you make money. When the price is higher, you lose money. So pretty straightforward. So that's a call credit spread. Now, one of the things I want to notice is that we position this, and this is one of the great things about spreads, is we position this where we are already in a money-making position, if you will. In other words, this 150 price, which is where price is now, that's at the money. That's the one that we're actually slightly in the money by 27 cents. But the point is that if we stay in this range and time goes by and it expires, the price doesn't even have to move and we make money. So I can position it that way. Or here's another example. This is the same kind of call credit spread, but you'll notice at this point, if it just sits here, I'm going to pretty much be at break even, right? Here's the zero line. And so this one is positioned a little further down. Instead of a 150, 160, we used a 145 and 155. So it's not so easy to make money. Price has to move, and it has to move down. Whereas the previous one, price could move even up a little bit, and I'm still going to make money. In fact, all the way up to about 156 and a half or 157. So this one is an at the money call credit spread. Now, the probability of making money might be a little less on this one, but you'll notice the risk reward is a little better. I make 500 and I'm only risking 500 instead of 300 to 700. So those are the trade-offs, and that's frequently going to be the trade-off. So keep that in mind, is that your probability of profit is often in exchange for your risk reward ratio a little bit. Okay, let's take a look now at a put credit spread. So a put credit spread is done with puts. Let's look on down here at the bottom. In this case, now Apple is still at the same price of around 150. But this time I chose these that are really way out of the money, 130 and 140. So I'm 10 points out of the money with my more expensive one, right, which is my $1.05. I'm selling that one, and then I'm buying a less expensive one, so I'm going to have a net credit of 65 cents, right? And times 100 is $65. So I can make $65 if we stay in this range or even if we drop all the way 10 points or nearly 10 points, I still make $65. So this one has a fairly high probability, or at least a much higher probability of making money, because I can go up to the moon, or I can stay where I'm at, or I can even drop as much as 10 points and still make money. Now, remember I said that the trade-off for high probability is not as good a risk-reward ratio. So here's an example of where I'm risking $935 to make $65. Now, this is going to happen in probably the period of a month. So this is not a terribly uncommon trade. A lot of people will do it because even though the risk reward's not as good, the probability is high, and I'm still making about 6% or 7% in a period of a month. That's not so bad. If I did that each and every month, you'd have a pretty good trading strategy. So I'm not suggesting you should do that. I'm not saying that's even something that I do all the time, but there are times when you feel bullish on a trade, you can position it a little bit out of the money, and you give yourself a fairly decent probability of succeeding. So a put credit spread is always bullish, and so kind of the opposite of a call credit spread. And again, it could be positioned right at the money and you could have equal risk reward, or it can be positioned out of the money like this, and your probability of profit goes up and your risk reward goes down a little bit. Hopefully that makes sense. Now, just in general, to summarize what we've kind of already gone over, call credit spreads and put credit spreads, those are the examples we looked at, tend to be respectively bearish and bullish. The opposite's true with debit spreads. A call debit spread is bullish and a put debit spread is bearish. So something to keep in mind. It again, not something you have to remember because your analytical software will always show you, but generally speaking, if you want to construct a position that's a little bullish or a little bearish, we can do it fairly simply with this kind of a spread. Now let's look at a couple other unique ones. This is called a butterfly. Now a butterfly, this is going to be a little, maybe I'll try not to complicate it. You can actually see what it is here. It's fairly simple really. You're buying one of the strike prices. In this case we bought 160. We sold two at 150 and we bought one at 140. So there's 10 points between the center of the tent here, 150, and 140 and 160. There's 10 points on each side. Anytime you have an equal distant, we call that a balanced butterfly. Some people make different distances on, say, the downside than the upside, and that would be commonly referred to as a broken wing butterfly or an unbalanced butterfly. Also, sometimes you'll see situations where people will sell different amounts on maybe one side than the other side, also an unbalanced butterfly. So generally speaking, the most common form of just what we call a butterfly is this, where it's balanced. Now, if you look at the graph here, you can see that if I stay anywhere between 144 and 166, something like that, that range is going to be the money making range. If I go outside of that range at expiration, you can see it starts to go down, and I have a maximum risk of $400 to make $600. Now the odds of actually making 600, to be honest, is pretty slim because you'd have to nail it right in the center of this tent. So generally speaking, when people trade butterflies, they're looking at kind of this, this range here. It's not, people don't generally expect to be right at the top, although it happens, but it's pretty rare. So when you look at strategies, you'll want to think more about where are things likely to end up and position them there. Now, some people you can also position butterflies out of the money or in the money. So we could place it way up here. We could place it way down here. And what we would be doing then is we would be creating a more bullish or bearish position versus this, which is a very neutral position. Okay, let's look at something different. This one is called a condor. Now condors are a four-legged spread, and you can see down here what I've done is I created, and if you just look at the top, what we did was we bought one at 180 and we sold one at 170. And so and we use puts to do this one. You can do them in calls also, it doesn't matter. But what we've done by basically selling one that was more expensive and buying one, if you just take the top two here, it's basically a put credit spread, the same as what we looked at before. And then we did a put debit spread on the other side. I'm sorry, I have that backwards. This is the put debit spread where we sold the more expensive one, the 130, and we bought the less expensive one. This is a put debit spread. The bottom section is a put credit spread. It's exactly like we looked at before, and it's just two of them put together. You have a put debit spread on one side and a put credit spread on the other side, and now I have this entire range where I can profit. So if I think that a security, in this case Apple or whatever your underlying is going to stay within a range, maybe it's been hanging around, it's kind of slow moving, what can happen is we can profit just from time passing as long as we stay within a pretty large range, and you can build these bigger and bigger. Now, in order to do that, again, when you have a fairly high probability of profit, you have this kind of a risk-reward ratio. So in this case, I'm risking 820 to make 180. That might not be a bad trade. Just depends on how volatile or how much movement you're expecting in your underlying. All right, what else do we have? We have a calendar. Now here's an example of, we called this, if you remember, a horizontal spread, and that's where we are we're buying in this case, a January, a further out expiration, and we're selling a December, and that's costing me $2, right? Because the December is shorter dated, so at the same strike price, it's going to be less expensive. So the one that I'm selling is less expensive than the one I'm buying, therefore it's a debit. In this case, I've got a peak of around $200, and I've got a total risk of around $200. And these generally are done when people think, there's kind of a couple reasons to do calendars. One is that they profit from increased implied volatility. So when people expect a lot of movement, a calendar can be a useful tool. We're going to talk about implied volatility a couple of videos down the road, so you don't need to necessarily know what that is right now, but that's one of the reasons people use calendars. The second reason is a lot of times they're good for just a neutral trade, and they profit from time decay. So again, if we stay within this range of say 145 to 155, I'm going to profit just as time goes by, because this is where things will end up at expiration. So that's kind of a simple way to use calendars. There's lots of more sophisticated ways, but that's another type of trade. So I'm going to leave it there. It's a fairly simple. That's a fairly simple set of examples of what option spreads are. There are so many more, many different ways, and you can sort of imagine if you just look at an option chain, you look at all the strike prices and all the expiration dates, the way you combine them is really almost endless. And people have created many different sophisticated strategies from using these different combinations. And I just wanted to show you some of the most common examples. Okay, well, that's going to be where we're going to leave this one. And the next, as we go on from here, we're going to get a little more sophisticated, and we're going to look at option Greeks. So be sure to head to the next module.